Hey guys, Freaky Finance here. This week we're going back to the US for a tech company called Opera. It's a pretty interesting company. The reason why I'm doing the video today is that they report earnings on Tuesday, and I want to revisit this video after I post it and see kind of what trends are still happening, if there's anything that's changed, and if hopefully if the price goes cheaper I can buy more. That's the idea. It also kind of fits. We did Dental Corp last week where it has the favorable policy in Canada. This one has a favorable regulatory policy as well, specifically more in the EU. It's already started more in the UK now too, and then in North America, especially in the US. There's a lot more pressure on these other browsers, the big browsers, the browsers that I use all the time. So I'm always on Chrome, always on Explorer, and Safari now and then on the phone. And this is a competitor to those. So they're against the big boys, and it's basically an underdog story. There's a lot of things going on. So this isn't just profitless tech. This is a company that's been around for a bit. It's profitable, has a good balance sheet, growing 40% year over year currently, only guiding to 24% for the year, but still pretty good when you're getting 15 times earnings with an immaculate balance sheet. So anyway, we're going to go into all that real quick here, but it's definitely interesting. When you turn over that rock, you're like, okay. And there's a couple of reasons maybe why it's just cheap as it is, but we'll go through those as well. So advertising is now huge. It wasn't always the case. It used to be a lot more search dominated. Advertising's just grown so much so quickly that it's now outpaced search, which is basically their partnership with Google, say predominantly. So that is an important partnership, and I think it expires at the end of 2026, based on what I read on the 10K. And you can see a lot of advertising partners here. We're going to go into that source in a second. On the advertising side of that pie, so 67% of their business, flag, speed dials, and Opera ads. Speed dials, for context, this is the browser. This is the speed dial at the top. And this is the, basically, the companies are paying for this placement. So when they open the browser, it's like the landing page. And basically speed dials you into certain things. So obviously Amazon advertises with Opera. Booking.com advertises with Opera. You can see YouTube here as well. And Timo and Ally, and you can add whatever you want. So there's a couple interesting things on the browser. The browser has a lot of cool things. I'm more of a gamey person, so I like this browser a lot more because it ties into Twitch, Discord, my Twitter, and my Facebook, right? And it also has a built-in AI function here, which I was just playing with. I was like, why is Opera a good investment? And then I just came back and said, basically do my own work. But anyway, and it also has these self-serve DSP. DSP is just demand-side platform ads. Basically, they actually campaign and advertise it themselves. They actually manage it themselves and just see how their ad is doing across Opera's platforms. And they have quite a few platforms now. Search, 33% of the business, largely with Google, I would say. It's slower grow, so it's only growing 8% year over year versus this growing 63% year over year. So again, advertising is the growth engine. Search has been kind of slow, and it could even decline, which might be a reason why we're getting the price. Because we have seen pressure in legacy search partnerships with Google as a lot more go to this AI model. We'll see if that continues, but it's something to keep your eye on. This could continue to slow, whereas this one I'm pretty excited about longer term. In terms of the competitive set, this just shows how small Opera is. Like the only other one I've ever used is Firefox, and that was like twice in university, like 10 years ago. 20, I don't know. But anyway, so very, very fragmented market. Opera only has almost 2% of desktops worldwide. North America mobile, barely even there, right? Safari just destroys that side. So I thought that was interesting. Opera is doing quite a few things, right? They have resource limiters on Opera GX, which I like. So you know how Chrome, I run Chrome all the time. It basically chugs a lot of my CPU. Like I can see it in my task managers. Right now it's taking 61% of my memory, Google Chrome. It's the biggest one at the top. Just looked on my other monitor. So there's a resource limiter that Opera has. They have a built-in VPN. But there's a lot of cool things I like, and the UI is pretty good to me, and it's more customizable in my opinion versus Chrome, even though Chrome has extensions that I use quite a bit. So there is some favorability here and some perhaps superior product, but we'll see. When I turn on the VPN, it can be kind of slow, but that's usually VPNs are slow. So we'll see. This is the reason why I'm excited about the company, at least in the next 5 years, or at least 3 years, is the big tech companies are getting a little bit of pushback just on how they market themselves. So when you buy a new iPhone, basically Safari was stuffed down my face for the last, I don't know, since the iPhone really started coming around. I started buying an iPhone in 2008. So it's been almost 20 years of just always Safari as the default, right? When I buy a new computer, it's always Microsoft Edge in the bottom left pin down there for me, right? There's a default, so I always have to get Chrome because I just view that as a superior one for my purposes, because I love having so many tabs, obviously. So anyway, we're seeing a ballot screen concept come in the UU, and this really helped the business for Opera. And I think this trend's going to continue because it's the lowest cost to the big tech guys, while also at least showing people that they have a choice, which wasn't the case before. Like no one probably even knows about Opera in North America. Very few people, and that's because the big guys never even let them into the store, right? Not even let them show up. Like, this is my monopoly. So I think the choice screen is the easiest tier of thing. Like, I don't think they might break up a company. Obviously, I'm overweight Google. Here, I'll just show this real quick. I should show. So I do own Opera, and here's the Google weight right here. So I am still overweight Google. I've been slowly trimming it, but it keeps rallying, so I'm still kind of overweight position. Opera, on the other hand, is not yet at a normal weight position. It's not yet at 5% of the portfolio, but it is one of the quickest ones that I've taken up. Usually I follow a company, I'll slowly add. You can see these very small amounts, right? Like 4,000, 1,000, $500. And that's me trying to just follow, keep track, keep it on my radar, and keep looking at it over time, and familiarize myself with the business as we go. This is one of the few that I picked up the rock. It was like instantly like a 2 or 3% position. That's worth pointing out, especially because we're going into the first earnings season where I'm going to be very paying attention and seeing whether I'm right or wrong, or what I missed, or whether it's an opportunity or not, really. But I want this video out before then. But I do own this one. In terms of the effect of the ballot browser, you can see France 402% increase, Spain 143%, Poland 68%, Germany 56%. So material growth unlocked for Opera. It puts it on the front page, like, what browser do you want? Like, actually, they list a bunch of choices, right, on this browser ballot screen. And then sometimes you can, as soon as you open a new browser, it's always going to ask you to default. Like Edge and Chrome are constantly fighting with each other on mine, and now Opera's also trying to become my default, right? It has at the top, do you want to be your default browser? So anyway, that's worth pointing out. And then I asked Gemini, what other value unlocks could there be? Is this a trend that's likely to continue to spread? It's kind of a leading question, because I know it is, because we can see the regulatory battles already. Department of Justice versus Google in America, right? In America, there's different remedies. Some of them are like breaking up the company, which I think is a little bit drastic. Could happen, but it's harder. But it's a harder avenue to go than versus just offering people a choice and letting them make their own decisions, right? Which is the way you went. So, which I think that's an easier route. So I don't know which way these are going to go, but I feel like they're going to be easier route to be like, just give people an option, right? And if you have a good product, they're going to choose you anyway. Maybe they're used to you by now because you basically had a monopoly for so long. They might pick you anyway as a default. It's because they're familiar with you. But it at least lets these little guys play, right? And so I think this is a very important notion. And AI does bring up a good point here, that the outcome will be court-ordered remedies rather than proactive legislation, which could take years to resolve. United Kingdom, very highly likelihood imminent action. So this one, AI thinks very going to happen relatively quickly, and they think the outcome is be very much like the EU, mandating a browser choice screen, the conduct requirement on Apple and Google. That's worth pointing out. There's other ones of high likelihood of fast followers, Australia, Canada, and I think that's just best practice. And importantly, these areas, while they're more Western, they're also the places where the higher ARPU is. So one of the things you're going to notice is you're going to see the user count in North America and the ARPU, the revenue per user, shoot up, but you're going to see overall users decrease. And that's one of the things with this platform that's, in terms of investment, that's the weakest thing of this investment, is that you used to have 350 users, now you only have 290 something users, right? Now you're making a lot more, like 400% more per user, but you've lost about 20% of your users on the platform, which isn't a growth platform, right? So you need to start taking share back in rest of the world while still doing this focus on obviously the more lucrative places in the world for advertising, which are the Western places. We've done videos on Pinterest that show this, and we talked about Meta and just how much the ARPU is greater in North America versus rest of the world. here's some other things that Opera, what I like I said, the built-in VPN, the Twitch and Discord integration, right, and the network limiter. Those are like the ones that I like. It does have a built-in ad blocker, and it does have a floating window. If I'm watching a video, I can minimize it if I'm doing other things. This is what I want to show is the strength of here. So it's growing in the high value areas. It also has good growth with the gaming community. Here you can see the EBITDA margin. I mean, when rubber hits the road, is the company making money or not? It is, which is nice. So it's not like I'm waiting or speculating. Getting paid a decent dividend while I wait for something on a regulatory side, which I think is likely to help the business. At the same time, I'm getting probably one of the best prices it's ever traded at a pretty good balance sheet with materially positive free cash flow. So anyway, you can see the growth over time. We're getting almost a better price than we were at these points in time, even though the company is obviously about 2 times better in EBITDA. Here's probably the most important slide. If I could just pitch this in 1 minute, it would be this. This is trading at 15 times earnings. Tell me why. When I see companies growing like this, usually they don't even have earnings yet, right? They don't have positive free cash flow. It's just this we think are going to keep growing. But just look at this revenue growth with the margin. Like you're constantly above the rule of 40 while trading at 15 or 16 times trailing earnings, right? That doesn't account that you might be still growing earnings 20% year over year, 10% year over year. But it's just, in my mind, it's just like, okay, what's going on here? You can see on the latest quarter, EPS was up about 35% year over year on an adjusted basis. Here, I was just digging to see what the dividend was and how they paid it, because I saw that it was higher on the cash flow statement for Q1. So they have a semi-annual dividend that was paid in January. That shows up here. So I was like, okay, if the cash flow, this is kind of, there's a lot of working capital noise here. You can see here, $20 million swing in just AR. So if you take out the swing, you're about flat year over year in terms of free cash flow generation. But you can see the dividend shot up, but that's because it's semi-annual. So it's not 35 million a quarter, it's 35 million every 2 quarters. So that's worth pointing out. So they can afford the dividend. When I first looked at it, I was like, okay, maybe it's priced in dividend cut. But then I checked it and I was like, okay. Now it is kind of high relative to the valuation of the company, especially for a tech company that's trading very cheap. I would much prefer them to buy back shares at 15 or 16 times earnings than pay a dividend. But that's just my opinion. What else? Oh yeah, the balance sheet is immaculate, which is nice. So you have positive retained earnings, a history of profits. You have cash and cash equivalents of 103 million, which is nice. And the most important thing, you have the investment in OPay, which is another thing that they own. They have a 10% stake in, and we're going to go into some of the details of this valuation. But this is another catalyst of value for the company. It could even be, like right now it's worth $258 million, and Opera's valuation is only like 1.4 billion or something. And if this price is where it could price, it could be worth this, what they have it marked at, or it could be worth double this, 500 million, right? And we're going to go into that metrics in a second. What is OPay? So it's a mobile payment fintech company focused on emerging markets, Nigeria and Egypt. Oh, I should have finished. I always look, because there isn't very much debt, I just skipped it, but you can see there's no traditional debt. So just standard working capital noises. So that's why the balance sheet of favorable cash position, favorable investments, favorable free cash flow, and a history of profitability. So balance sheet's fine. So OPay, mobile payment fintech company focused on emerging markets, Nigeria and Egypt. OPay, online and offline payments. All right. So what I like is here. So this is on the 10K, so on page 105. And here you can see how they basically value their investment, $258 million, which is material for the company. And they're like, okay, we think it could be worth 3 to 6 now, but prior we thought it could be worth 2.9 to 8. So they actually took down the top range in 24. The IPO market was weaker. It's recently accelerated a bit, and that actually accelerated under Trump last time too. The IPO market, no reason why, that's just what happens. Here you can see the time horizon shortening. So they're expecting either an IPO or a sales transaction of OPay in the next 1 to 2 years. And you can see the probability is shot up to about 80% probable that they think they're going to IPO this company, which is a material value unlock. If we go to the midpoint here, that would be 4.5 if this happens. It would be about $4.5 billion, of which they own about 10%. So that'd be about $450 million. So, which is a material part of their market cap, right? And it could be a material unlock of cash, which they could either dividend, I prefer them to buy back shares, But there's this on the balance sheet as well, which is an added bonus when I dug through it. Not only was it I was worried that it'd be like an over leveraged company, that's why it's trading so cheap, but the opposite was true. Here's just another good slide to show the total MAUs decreasing, and this is important. This is why I think the share price hasn't moved much as we've seen the growth in the company in terms of EBITDA and revenue growth, is because this total MAU count has been decreasing and they're not sure where it will stabilize. And I don't think analysts are sure either. So the strength, I want to show both at the same time, because this is, in my mind, this is the greatest strength and weakness in one area. So you can see the ARPU shooting up almost 2x just in 8 quarters, right? Just imagine 8 quarters, you make double per user, but you did lose a decent amount of users, 10% of your users. So you're making 100% more per user, but you lost 10% of them. And that's part of the strength of the advertising in North America. And it's partially amplified because of the regulatory tailwinds that they're seeing, because they're finally able to play in the sandbox of the big guys that have had monopoly on the space for so long. Here, just to show off really quickly, we kind of talked about the financials already. They have a nice download. You can see the revenue going from 37 million a quarter to 142 million a quarter. So it's more than 3x over the last 6 years. You can see the growth. Well, there was growth in search. It's kind of flatlined. And advertising's really picked it up, right? You're going from 14 million to 95 million a quarter. So material growth in advertising. Importantly here, I kind of have in purple because I was looking at the seasonality. Usually Q4 for advertising. I looked at a lot of advertising companies over time. Usually Q4 is big. And you can see here, usually Q4 is 10% bigger than Q3. 10% bigger, 10% bigger, 10% bigger. And then all of a sudden here, materially bigger, right? More than 10%. So you have an acceleration into the Christmas. And far more important is you're able to hold it and beat in the Q1, which hasn't happened in the history of the company, right? Like very rarely outside of COVID was Q4 or Q1 above Q4, right? So that's material as well. This place on the personnel side, this is where the obvious scale is. You can see in Q2, they're only making 77 million a quarter, paying 17.5 personnel. Now they're making 142 million per quarter, and they're paying the same amount. So that's special. This is the line to watch in terms of margin compression. It's the cost of the inventory, so the cost of the ads. So that's a line to watch. Is it growing in line with advertising? Now, it's still showing scale on all these other lines, which is fine. So that's the main thing. I just want to make sure this doesn't go too high versus what we're seeing on advertising. That's something to point out. But again, you're seeing material scale, especially on the fixed asset or the fixed cost side. As the business grows very well, you can see that in the operating margin going from some months positive, some months negative. So some months are making money, some quarters are losing money, versus constantly positive and profitable. Here, you can show that another way in the net margin. And here you have actual losses for a bit and then back to profitability. Here you had them buying back a decent amount of their shares and then they stopped and now they're paying a dividend. On the trailing 12 months, they have 94 cents in earnings power, which is pretty impressive with a share price only at 16 bucks, especially given this growth that we've seen, right? Like it's literally gone from 37 million a quarter to 142 million a quarter. And it's trading at 16 times, which is very special. And in terms of cash flow, it's free cash flow positive. They don't put very much back in the business in terms of traditional CapEx, so it's CapEx light model. And the trailing 12 months is 73 million free cash flow, which is very nice for a company that's $1.4 billion. And if I were to take out OPay, it's probably traded under $1 billion in what I think is the current EV of the standalone business. So when I would take out the 100 million in cash, probably have 900 million. So it's trading relatively cheap on a trailing 12 months basis. And here again is the biggest strength, the weakness. So total user count decreasing, but you're making materially more. And this is even more dramatic. If I go farther out, you can see they used to have 350 million users. Actually at high point 388 million. And now you're down to 292 now. But you were only making 40 cents a user before. And now you're making almost $2 a user before. So material unlock in terms of ARPU. Though the market, like if you stretch it out forever, you're going to need users to actually pay the ARPU. So you don't want that to decrease too much. So you just don't know. The market's not sure where that ends out. But I think having a favorable regulatory environment should help put Opera on the radar of more people. It should actually help them in the long run. So it's headquartered in Norway, but they do have Chinese ownership in the company. Zanue Zhao is technically worth more than the whole company put together. So he could also buy this out. This is actually a con against the company. When I was going through research, basically kept coming up like this is owned by China, so maybe don't trust this VPN or this browser like you would other ones. But I mean, technically it's owned in Norway. It just has Chinese influence on it, which is probably one of the reasons why you see Temu and Alipay on the landing page for the speed dial thing. But so that's worth pointing out. Right, estimated net worth 2.2 billion, and he's done this type of thing before, where he invests and grows companies and then sells them. So that's also worth pointing out as topical as of today's date, because we're seeing like the in my mind the fake bids for Google Chrome, like the way too cheap valuation for Google Chrome that Perplexity put out and OpenAI is interested in. And a lot of these AI companies want browsers because they flow in so well, right? They're right there on the page. Like we're seeing this across the line. You're going to see it in the Gemini. Eventually it's going to move to the browser. Copilot's on the side. You just drop it down. In Opera, you have it right here, right? Everyone's going to want this kind of setup. And so I think that it also says that someone could be looking at Opera as an easy tuck-in. I mean, there's 300 million users, and you have a regulatory environment that supports this type of transaction. So anyway, I just want to point that out. It's an interesting company. It's one of the cheapest companies I've looked at that's growing like it currently is. So the market's expecting a further decline in growth, which is likely. It's hard to grow 40% a year forever. I mean, they're only guiding 23% this year, but they're not asking for much. I would prefer them not to pay this big dividend and just buy back shares when you're trading so cheaply, but that's just my opinion. And for all I know, maybe they do that on Tuesday. They cut the divvy and buy back a material amount of the company. Especially with OPay coming up, like when that IPOs in 1 year or 2 years, that's another value catalyst for the company. So anyway, I'd like to know your thoughts on Opera, and have a great rest of your week.